$2.7 trillion. Quietly moved, no press conference, no warning, no breaking news banner. JP Morgan, Goldman Sachs, Bank of America, not million, not billion, trillion, with a T. And the timing is the part that should scare you the most, because the biggest movement didn't happen during panic. It happened while markets were celebrating. Stocks were near all-time highs. The media was repeating the same phrase like a lullaby. Soft landing, inflation beaten, recession avoided. While you were hearing that, the banks were doing something else. They were moving money out of the exact places that get destroyed when the next crash arrives. And here's the truth most people never learn until it's too late. The financial system doesn't collapse randomly. It collapses in stages, a pattern so consistent that once you see it, you can't unsee it. In this video, I'm going to show you the same four-stage pattern that played out before the Great Depression, the same pattern that played out before the 2008 financial crisis, and the same pattern that appears to be executing right now. Because $2.7 trillion doesn't move by accident. It moves because someone knows something. And if you want to understand what the banks saw before they moved, stay with me, because I'm going to show you the historical proof, the current signals, and what it means for anyone holding assets inside a system that is already repositioning. Most people think crashes happen like earthquakes. One day everything is fine, and the next day everything collapses. But that's not how it really happens. Crashes are more like controlled demolitions. The building looks stable from the outside until the final moment. But the people inside, the insiders, the engineers, they know the charges are already set. They move first, quietly, technically. And then, when the collapse becomes obvious, it's already too late for the public. This is not a conspiracy theory. It is a repeated behavior pattern driven by incentives. Big institutions don't wait for headlines. They don't wait for the public to panic. They move early because early movement is the difference between survival and destruction. And the key is this: the exit is always silent. That's why the average person never sees it. They don't announce the shift. They don't run commercials saying, "We are reducing risk." They use boring language. They hide it behind technical explanations like portfolio optimization and risk management. They spread it out over quarters so it looks normal. And by the time it shows up in filings and reports, the repositioning is complete. So what exactly happened here? Between Q2 2025 and January 2026, major banks and institutional money repositioned roughly $2.7 trillion. And it didn't move into exciting new investments. It moved into safety. It moved away from risk. It moved away from sectors that break when credit tightens, liquidity dries up, and refinancing becomes impossible. It moved away from commercial real estate. It moved away from regional bank exposure. It moved away from long-duration bonds that can get crushed in the wrong environment. It moved into short-term Treasury bills, cash, and even gold. That is not random. That is not normal. That is preparation. And the most suspicious part is the timing. The peak movement occurred in December 2025, the same month markets were celebrating and hitting highs. This wasn't a coincidence. It wasn't just rebalancing. It wasn't routine, because this exact type of silent exit has happened before, twice, and both times it happened before a massive collapse. In 1928, insiders moved early while the public celebrated, and 12 months later, the Great Depression began. In 2007, major institutions shifted and hedged quietly, and 18 months later, the global financial system nearly collapsed. Now we are at month 9 of another silent exit cycle. That matters because history doesn't repeat perfectly, but it often rhymes in very uncomfortable ways. Here is the pattern you must understand, because everything in this video is built on this. The system moves in 4 stages. Stage 1 is accumulation. Stage 2 is peak confidence. Stage 3 is silent exit. And stage 4 is when the collapse becomes obvious. When stage 4 arrives, the news calls it unexpected. The public calls it shocking. Politicians call it unpredictable. But insiders already moved during stage 3. Stage 4 isn't the beginning for them. Stage 4 is the moment the public finally catches up to what the insiders have known for months. Stage 1, accumulation. This is when banks and large institutions build massive exposure in whatever sector is growing. They don't just invest in the trend, they create the trend, they fund it, promote it, expand it. In the 1920s, the growth story was industrial stocks and consumer credit. In the 2000s, it was mortgage-backed securities, housing, and real estate derivatives. And in the early 2020s, it became commercial real estate, regional bank lending, and long-duration treasury exposure built during years of cheap money. When rates were low, long-term assets looked safe and profitable. When cash was free, everyone piled into risk. That was stage one. Accumulation happened quietly over years. Stage two, peak confidence. This is when everything looks perfect. Markets hit all-time highs. The media celebrates. Economists declare victory. Government officials take credit. The public believes the system has been perfected. This is the dangerous moment because confidence is the best hiding place for risk. It makes people stop asking questions. In the late 1920s, it was the Roaring Twenties, the belief that prosperity was permanent. In 2006 and 2007, it was the housing boom, the belief that home prices could never fall nationally. And in 2024 and 2025, it was the post-pandemic recovery, the soft landing story, the belief that inflation was beaten and the economy had been stabilized. Peak confidence isn't about facts. It's about mood. It's about narrative. And narratives are powerful enough to blind people. Stage three, silent exit. This is the stage we are focusing on because stage three is where smart money separates from the crowd. While the headlines stay optimistic, while people keep buying, institutions quietly move to safety. Not all at once, not in public. Gradually and technically, they reduce exposure in vulnerable sectors. They cut long-duration risk. They increase cash. They shift from 10-year bonds to 90-day bills. They buy protection through derivatives. They hedge. They reposition. And it is so quiet that to most people, it doesn't exist. But the numbers don't lie. The scale of movement reveals the truth. If nothing was wrong, institutions wouldn't be moving trillions into defensive positions. They wouldn't be sacrificing upside for liquidity. They wouldn't be building war chests. Silent exit is preparation for stage four. Stage four, collapse becomes obvious. This is when the public finally sees the damage. Credit markets tighten, defaults rise, liquidity disappears, assets get sold at fire sale prices, companies fail, some banks fail, headlines flip overnight from everything is fine to crisis. And by this point, the repositioning is already complete. The banks that moved early have cash. They can buy distressed assets cheap. They can acquire competitors. They can survive the storm and expand. The public, meanwhile, is still holding assets that collapse in value, and they are holding them at the worst possible time. Now, let me prove to you this isn't just storytelling. Let's go back to 1928. Early 1928, the US stock market was at record highs. The Dow Jones had risen dramatically. Optimism was everywhere. Newspapers ran headlines about permanent prosperity. Political leaders spoke as if the economy had entered a new era. People were buying stocks like never before. Regular citizens, bartenders, barbers, shoeshine boys, everyone was talking about portfolios. It felt like the whole country had discovered a cheat code for wealth. That's stage two, peak confidence. But while the public was celebrating, stage three was already happening. Between January and September 1928, powerful families and insiders quietly reduced exposure. They didn't announce it. They didn't give speeches. They just moved. Wealthy insiders sold significant holdings while the public poured money in. And later, after the crash, the public learned what happened, not from the headlines at the time, but from history. There's a famous quote attributed to Joseph Kennedy. When the shoeshine boy starts giving stock tips, it's time to get out. Whether every detail is perfect or not, the message is true. When speculation becomes culture, risk becomes invisible. Insiders notice that. They exit quietly. And what happened next? In late 1929, the market collapsed. Black Thursday, Black Tuesday, panic selling, margin calls, fortunes evaporated. By the early 1930s, the damage was enormous. But here's the part most people miss. Those who exited early didn't just survive. They got richer because after the collapse, they had cash. Cash is power in a crisis. They bought assets at a fraction of their previous price. They built fortunes on the wreckage. If you only remember the crash, you miss the real story. The real story is the repositioning that happened before it. That was the silent exit. Now let's move forward to the 2000s. By 2006, housing looked unstoppable. Home prices had risen for years. Subprime lending was exploding. Anyone with a pulse could get a mortgage. Wall Street packaged mortgages into securities and sold them worldwide. Rating agencies stamped them as safe. Banks, pension funds, and institutions around the world bought them. The system looked invincible. That was stage two, peak confidence. The narrative was simple. Housing never falls nationally. The financial system is sophisticated. Risk is managed. This time is different. But stage three was already happening, quietly. From 2006 through 2007, certain institutions began repositioning. Some reduced exposure, some hedged, some shorted. And the public didn't see it because the public does not read balance sheets. The public does not track derivative hedges. The public does not decode quarterly filings. But institutions do. When you have billions at risk, you don't trust headlines. You trust positioning. We even know of famous examples. Investors like Michael Burry saw the housing weakness early, made a bet against the system, and made billions when it collapsed. Hedge fund managers like John Paulson profited massively by positioning ahead of the crash. But the larger story is the same. Insiders repositioned before the public understood the danger. And while the public kept buying the dream, insiders were preparing for the nightmare. Then stage four arrived. Bear Stearns collapsed. Liquidity dried up. Lehman Brothers failed. AIG needed a bailout. Washington Mutual failed. Markets lost trillions. Retirement accounts were crushed. Home values collapsed. Unemployment surged. And only then did the headlines admit the truth. But by then, stage three was already finished. The people who moved early survived and gained power. The people who believed the narrative got hit the hardest. Now here is the part that brings us back to today. In 2025, we heard the same type of language we heard before other crashes. Mission accomplished. Inflation is beaten. Soft landing achieved. Financial media repeated it on loop. Politicians smiled. Markets celebrated. And that would be fine if it matched institutional behavior. But it didn't. That's the red flag. Because while the public was hearing victory speeches, trillions were quietly moving into defensive positions. So now, let's apply this exact pattern to what is happening now. This is the part you need to pay attention to. I'm going to break down what moved and where it went, because once you see it, the story becomes clear. JP Morgan, Goldman Sachs, and Bank of America did not move $2.7 trillion because they got bored. They did it because they are preparing for stress. And the stress they are preparing for has a very specific shape. Start with JP Morgan. Between Q2 2025 and January 2026, JP Morgan reduced exposure to commercial real estate by a massive amount, not a small trimming, a serious exit. Commercial real estate means office buildings, shopping centers, multifamily housing, and other income properties. The problem is simple. These assets depend on credit. They depend on refinancing. When rates rise and credit tightens, many properties can't refinance. That leads to defaults. That leads to forced sales. That leads to banks taking losses. If you are the biggest bank and you see that coming, you reduce exposure early. That is what silent exit looks like. JP Morgan also reduced certain forms of regional bank risk and lending exposure. Why does that matter? Because regional banks often carry the most concentrated exposure to commercial real estate and local credit risk. They don't have the same safety net. They don't have the same diversification. They can't absorb the same shocks. So when stress hits the system, regional banks are often the first domino. That happened recently with bank failures in 2023, and major institutions learned the lesson. When the next wave hits, don't be holding the bag. And then there's the move that might be the most revealing. JP Morgan shifted significant holdings away from long-term treasury bonds and into very short-term treasury bills. Think about what that means. A 10-year treasury locks your money for a long time. A 90-day bill gives your money back fast. When a bank chooses short-term bills, it is choosing liquidity over long-term stability. It is saying, we want optionality. We want to be able to move fast. We want our money back soon. That is not what you do when everything is stable. That is what you do when you want to be prepared for a shock. Now look at Goldman Sachs. Goldman liquidated a huge amount of long-duration assets. Long-duration assets are anything that takes years to mature or anything that gets sensitive when rates change. Corporate bonds, mortgage-backed exposure, emerging market debt, long-term structured products. When institutions sell long-duration risk, they are reducing sensitivity to volatility and credit stress. They are moving away from yield chasing and toward survival positioning. And Goldman also increased cash, not a little, a lot. Cash is boring in a bull market, but cash is priceless in a crisis. Cash means you can survive, and cash means you can buy distressed assets later. And then there is another signal, gold exposure. Institutions don't load up on gold because they think it is trendy. They use gold as protection. Gold is a hedge against currency debasement and systemic distrust. When big institutions increase gold exposure, it often signals concern, not confidence. It signals they want insurance. Now, Bank of America. Bank of America reduced exposure to mortgage-backed securities and tightened their loan book. Even if some mortgage-backed securities are considered safe, the point is not whether the asset is good. The point is whether the bank is seeking liquidity and reducing long-term risk. When banks reduce loan exposure, they are signaling they expect credit stress ahead. Businesses that depend on easy credit get squeezed. Consumers get squeezed. Defaults increase. The system tightens. And the banks position for it. Now, you might be thinking, if these moves are real, why doesn't the media scream about it every day? Why aren't people talking about it on every channel? And the answer is simple. This is not how financial signals work. Banks do not announce repositioning. They do it quietly using tools that are invisible to the public. They use derivatives to hedge. They move exposure through internal changes and fund structures. They adjust slowly so it looks normal. And when the data finally shows up, it shows up in dense quarterly filings, buried in hundreds of pages of technical language. Most people never read them. Most media companies don't cover them deeply. And by the time anyone notices, the movement is complete. That is why stage 3 is so dangerous. It happens while everyone is calm, and it ends before anyone panics. Now let's connect the repositioning to the underlying stress points in the economy, because stage 4 doesn't arrive for no reason. There are specific pressure points building right now. The first one is commercial real estate refinancing. A massive amount of commercial real estate loans are maturing between 2025 and 2027. That means owners have to refinance, but rates are much higher than they were years ago. Refinancing at higher rates can make a property unprofitable overnight. When that happens, owners walk away, banks take losses, and the most vulnerable banks are often regional banks. The second pressure point is the yield curve inversion. When short-term rates are higher than long-term rates for an extended period, it has historically been a strong recession warning. The key is duration. When the inversion lasts long, it signals deep stress beneath the surface. It signals tight money conditions. It signals that credit will get squeezed. And when credit gets squeezed, something breaks. The third pressure point is institutional parking. When big money wants safety, it looks for the lowest risk places to hide. One example is money moving into short-term government instruments and high-security facilities. The point isn't the exact vehicle. The point is behavior. When institutions choose safety over returns, they are telling you something about the risk environment. The fourth pressure point is corporate debt refinancing. A huge amount of corporate debt needs refinancing in the coming years. Many companies borrowed when rates were low. If they have to refinance at much higher rates, their payments jump. Profit margins shrink, defaults rise, layoffs rise, and stress spreads. The economy does not break from one big event. It breaks from many weaker points cracking at once. Now return to the 4 stages, because now the timeline becomes clearer. Stage 1 for this cycle was the stimulus and cheap money era, where institutions loaded up on assets as money flooded the system. Stage 2 was the peak confidence period, where markets rallied, narratives turned positive, and people believed the soft landing story. And stage 3 is the period we are in now, the silent exit. This is the period where institutions reduce risk and move to safety, while the public narrative still sounds optimistic. And stage 4 is what arrives after the silent exit is complete. Stage 4 is where stress becomes visible to everyone. And here's what you must understand. By the time stage 4 arrives, the opportunity window has already closed. That is why this topic matters. It is not about fear, it's about timing. People often say, I will react when the news changes. But by the time the news changes, the movement has already happened. By the time the headlines turn negative, big money is already positioned, and the public is trapped. This is the part that hurts. The system is designed so that the public provides liquidity. When people feel confident, they buy. When people feel safe, they take more risk. When narratives are positive, they hold on. And that gives insiders the ability to exit quietly without crashing the market too early. This is why stage 3 can exist. It is the calm period that allows silent repositioning. So what does this mean for you as a normal person watching this? It does not mean you should panic. It does not mean you should blindly sell everything. Panic is what destroys people. What it means is you should stop trusting narratives more than signals. You should stop taking comfort in headlines while ignoring institutional behavior. You should understand that when trillions move into safety, it is a warning. It is a sign. It is not random. It also means you should recognize the difference between hope and preparation. Hope is believing the system will magically remain stable because it has to. Preparation is recognizing patterns and positioning so you are not forced into bad decisions during stress. The worst decisions are made under pressure. The goal is to reduce pressure before it arrives. History teaches us this lesson again and again. In 1929, people were told prosperity was permanent. In 2007, people were told housing could never crash nationally. In 2025, people are told the Fed has better tools. Technology is changing everything. And we have learned our lessons. And maybe some parts of that are true, but patterns still matter. Debt still matters. Liquidity still matters. Refinancing still matters. Human behavior still matters. And when institutions quietly exit while telling the public everything is fine, you should pay attention. Because $2.7 trillion doesn't move by accident. It moves because institutional capital sees something coming. And you have two options. Option 1 is to believe the headlines. Trust the same institutions that are quietly repositioning while the public narrative stays optimistic. Or option 2 is to understand the pattern, to see what insiders see, to recognize that when banks reduce exposure to vulnerable sectors, increase cash, shift to short-term safety, and hedge against systemic risk, they are preparing for a period where normal assumptions break. This is not about being pessimistic. It is about being aware. It is about being ready. It is about understanding that the system has stages, and we appear to be in stage 3. And stage 3 is the only stage where you still have time to make calm decisions. Stage 4 is the stage where decisions get forced on you. So what happens in stage 4? Stage 4 is when the collapse becomes undeniable. Credit tightens aggressively. Liquidity disappears. Defaults rise. Risk assets fall. Property values can drop. Certain banks can struggle. Certain companies can fail. The media changes tone. The public panics. And this creates the largest transfer of wealth because those who have cash can buy assets cheap. Those who don't have liquidity are forced to sell at the worst time. That is why the rich often get richer after crashes. Not because they are lucky, because they prepared during stage 3. And this brings us back to the title of this video. Why did every major bank quietly move $2.7 trillion before the crash? Because that's what they do before crashes. They move early, quietly, gradually, and they do it while the public is distracted by narratives. They do it before the collapse becomes obvious. They do it before panic hits. They do it when confidence is still high, because once stage 4 arrives, the window closes. Now, here is the key takeaway. You don't need to predict the exact day. You don't need to guess the exact trigger. Most crashes don't have one single reason. They have a final spark, but the fuel is built over years. The important thing is recognizing when silent exit is happening. The important thing is recognizing when the biggest institutions are shifting in the same direction at the same time. When that happens at this scale, it's not noise, it's a signal. And if you want to track this pattern with me, if you want to keep watching the stage 3 signals and prepare for what stage 4 could look like, then subscribe. Because in the next video, I'm going to break down what stage 4 typically looks like in real life, what early warning signs show up right before liquidity snaps, and what moves people make when they want to survive and even take advantage of the biggest wealth transfer moments in history. Like the video if you see the pattern, because content like this gets suppressed when it challenges the happy narrative. Comment below, what do you think the biggest risk is right now? commercial real estate, corporate debt, or something else? Let's build a community that sees the pattern early, so we are not forced into fear later. Because the machine is already in motion. The only question is whether you can see it clearly enough to make better decisions before it becomes obvious.